About the author. Gary Furr is in the business of helping business owners make more money. He helps business owners and executives dramatically improve their individual and organizational effectiveness so that they can take their businesses to the next level and increase their bottom line revenue. Gary's approach has grown out of 40-plus years of C-level business experience, an MBA in organizational development, and hundreds of interactions with business owners, observing their struggles to achieve the level of success that they envisioned when they started their business. In June of 2012, returning from an 8-day business trip to Russia, it took Gary 29 hours to fly home. That is when he decided it was time to do something else, because life is short, and working crazy hours is not the answer to a life well lived. Gary concluded that true wealth is not money, but free time to do the things you love and be with the people you love. As CEO of Gary Furr Consulting, he is helping business owners create that same freedom for themselves. Listen as Gary reads his book, It's Not Hard, It's Business.
Chapter 12. Pay the Taxman. I am running into more and more businesses that are operating in tax avoidance mode. I completely understand the desire to not pay the taxman more than your fair share, but in minimizing your tax burden, you may be creating bigger problems. A very successful business owner told me how they had been in tax avoidance mode for years. At the end of each year, they would pay out their profits to themselves and their employees in the form of bonuses to minimize the tax burden. The funny thing about this is that although the business was not paying as high a tax rate, the owners and their employees were paying the tax. When it became necessary to do a major remodel of their building, they went to their bank to discuss borrowing the money to remodel. The bank declined their request because they had minimal retained earnings in the business. Quite simply, there were not sufficient retained earnings to support the debt load. As a business owner in tax avoidance mode, you are likely trying to spend your money at the end of the year to avoid taxes. This, however, is a short-term strategy that will likely have a long-term negative impact on your business. Unless you are spending that money on assets that will generate additional revenue moving forward, then you should reconsider. Building wealth is better than avoiding taxes. When you're thinking about avoiding taxes, you're not thinking about creating wealth. As a business owner, you should be more focused on maximizing after-tax revenue to build wealth rather than focusing on tax avoidance. Tax avoidance nearly always results in difficulty borrowing money from the bank or other lending source. The problem is that bankers do not lend from the P&L or income statement. They lend from the balance sheet. When the business owner presents their financials, the banker turns to the second page of the balance sheet and looks at retained earnings or wealth in the business. That is where the trouble starts. The tax-avoidant business owner has not built any wealth, which makes the banker reluctant to lend them any money. Bankers like to apply a simple ratio to your business, the debt-to-equity ratio, and this is how they set limits on how much you can borrow. Typically, it is a 2-to-1 ratio, meaning for every dollar of equity you have retained in your business, the bank will let you borrow $2. No equity or retained earnings, no borrowing. Quite simply, minimizing taxes reduces your borrowing power. Selling your business. Another common pitfall related to tax avoidance occurs when it comes time to sell your business. Because you have been in tax avoidance, your business is not worth as much as it could be. Small businesses typically have a range of value of a 3 to 5 multiple of EBITDA. That is, earnings before interest, taxes, depreciation, and amortization. Mid-market companies tend to have a valuation of 5 to 7 times EBITDA. When business owners have been avoiding paying taxes, they have not maximized after-tax revenue, and therefore they have not built wealth or retained earnings in their business. This impacts their business's valuation. In other words, your business is not worth as much as it could be because you have been in tax avoidance rather than wealth creation. As my mentor and friend Phil Simchek likes to say, maximizing earnings will maximize your wealth. We should be focusing on wealth creation, not tax avoidance. Success steps. Number 1, understand your financials. Number 2, change your mindset from tax avoidance to maximizing after-tax revenue and building wealth in your business. Number 3, What is your EBITDA? Ask your CPA to help you determine this and track it.